You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Good morning, Jim. Good to be with you.
They've been throwing money in buckets around the Shanghai market. How does it look today?
Well, I think it had something like a 6% hit overnight in their trade. And this is after a setback here. But we might as well look at the whole action on it. Early in the year, it just took off, moving straight up. Now, on these charts, we can do our technical analysis on it. And when you got something coming out of a declined market and you get a hell of a rush, that can show up on, we've got a model called upside exhaustions, and it measures dynamics and time and all kinds of things. So when you're coming out of a hole like that, you can get a series of upside exhaustions, which we got. And then in a couple of bursts, there were others. So we were looking, when there were two of them, we were looking for a third cluster of upside exhaustion readings. And a couple of weeks ago, we just got kind of like one there. But it was similar to the action in Shanghai on the way up in 2007, similar compulsive move. So it was fabulous action. We have discussed the new issues they were doing, and that one in particular, they were out to raise $1.5 billion, and the orders for the stock amounted to the equivalent of the GDP for Hong Kong. I mean, amazing numbers. So anyways, the other part of that story was about villagers in remote areas in Hong Kong, and these are the ones who were opening up new accounts. They were all onto the story that the Morgan Stanley index people were going to put the A Hong Kong shares into this global this index, which meant that index funds would have to buy some of it. So when you got villagers in remote areas of China, buying a stock on the possibility that Morgan Stanley is going to put certain stocks into an index, hey, they know the story. So at any rate, it's had a couple of hits, and the latest one is running right down to the 50-day moving average. And as we've been saying on some of these indexes, it made pretty good highs. Taking out the 50-day would be step one, and then taking out the 200-day would be step two. But this thing looks like, well, this is what you want. And when you've got those extreme upside exhaustions reading, what you need to see as an end of the momentum or a break in the index. Well, we've got both. So correction indeed. It could be fair sell-off on that. But it also fits into a pattern whereby exchanges on bubbles, Europe and England were the history for a couple of hundred years, where their enthusiasms would peak in May or June and churn around during the summer months and then discover a panic in the fall. But beginning when the New York market became big enough to be noticed, the 1873 bubble, you had London peak in that May, and then New York went on and made a speculative thrust up into September. Then in 1929, it was a similar pattern, and you then also had the New York market, which was then becoming much more important, set its high in that fateful September. So here's the pattern we're looking at. Outlying exchanges like Hong Kong, which has set a high already, then more recently, a week and a half ago, Shanghai. And then as of this week, Nikkei is up there generating an upside exhaustion reading, and they added 1% on more after yesterday. So it looks like outlying exchanges could be peaking now, which would fit that historical model. And we'll look at the New York Stock Exchange, and you have a number of indicators that have been friendly to the move and are no longer. One was the Advanced Decline Index, which peaked a few weeks ago. Now, often it can peak, say, a couple of months from the actual top. So this one is suggesting that for New York, the high may be out there yet, the ultimate high. then also you've got margin debt, which for the April posting was spiking up there. And this is where the May posting will be interesting. I think it'll come any time now. So if you have a spike up for margin ending in May, then it has a margin tendency to peak some months before the actual senior indexes peak. So there's another one. Then you have the seasonality. If you're going to do an important high and you're heading towards September, it might happen then. So the senior markets in New York could turn around for a while, make some rallies, and then maybe set an ultimate high out towards September. And what's the probability of this? Well, you've had a change. We were talking about the credit spreads, which is the difference between investment-grade bonds and uninvestment-grade bonds. And they have a tendency to narrow with confidence into around May or June. Of course, the spreads widened enormously with the crash in crude oil right down to January. So then once crude stabilized and started trading sideways, that took a lot of pressure out of the junk bond market, and there was a pretty good recovery, so spreads narrowed. Then more recently, the move would be on this seasonal, where the spreads came into 176 basis points, say 4 or 5 weeks ago, and then started to increase a little. So the widening is there, and it needed to break above 186 basis points, and yes, it did. 189 on yesterday's posting. These are not big numbers, but it's enough to say that the trend is now on for widening. And we go back to the widening that occurred, for example, from June 1998, and that's when the whole world was expecting that the European Economic Community, as it came together, all the yields, like for example, Italian bonds would trade on the same yield basis as those for England, which was rather fanciful, and we pointed that out at the time. So here you are, how that one ended up whereby long-term capital management, a huge hedge fund, was highly leveraged against narrowing of spreads, and Mother Nature went the other way, and that turned out to be the biggest disaster in history at that point. So then 2007, party time, and the credit spreads started to widen that May. Early June, you had Bear Stearns fail, and then later on that summer it was Lehman Brothers. So that then marked the end, or the speculative end, of that great bubble in 2007. So here we are again. You've had a fabulous bull market, particularly fabulous in lesser exchanges, and you're having a classical seasonal change. So this is something that we emphasize, that the Federal Reserve, while they've done wonders in helping long rates to decline by their bond buying program, and then more recently it was followed up by the European Central Bank buying bonds, and they bought them very hard right down until April. So our work this year on the Treasury, long-dated Treasury market, was that in January we noted that the run was getting really quite impressive, and we were looking for ending action, and then I think it was January 20th we did the special study called Ending Action. Then by the end of the month we did have the upside exhaustion reading on a number of, like, the weekly and the monthly, such that we were confident that a top for the bond was in. Then on April the 9th, we noted that this decline in U.S. bond prices had gone far enough that perhaps it could hit the action in the European bond market. Indeed, the best on the German bond was set on April 19th, and then, as we all know, there's been a huge increase in yields in Europe. So these are relentless forces, and this one in Europe is particularly interesting because it overwhelmed monstrous buying by the European Central Bank. And you've had the central bankers around the world have been buying government bonds, treasuries, all this sort of stuff, and within their reserves. So if you have the price of these bonds being marked down, then the reserves of the central bank are being marked down. So, but for example, traditionally the reserve in a central bank was the gold position, and when you go into a contraction or a crisis, the real price of gold goes up, so those reserves are enhanced. But here, you go into a financial disaster, the price of bonds always goes down, and their reserves are going down. So their ability to inflate the economy or inflate asset prices is being diminished day by day as bond prices are being marked down. So this will be fascinating as we go through the summer. So to wrap up the stock and bond side, it looks like outlying exchanges that became very speculative are putting their highs in right now. And then there's a probability that S&P type stocks will turn around a bit in here, got a bit ahead of themselves, and then make highs perhaps late August, early September. But we will keep in mind that the greatest collapses have always followed great speculation, and the collapses have usually happened in the fall. I don't know why they happen in the fall, but the record is there. So then we want to move over and look at some of the commodities, and we played a rotation from around Christmas time where some of the depressed commodities would rally. The base metals did quite nicely. Some of the base metal stocks performed nicely, but that move was maybe out to around May. And as they became overbought, we advised and suggested taking cash off the table. And the grains never did really get going because there was quite a change in the weather, whereby some dry areas started to get some precipitation, but there isn't precipitation everywhere. But it was enough to keep a lid on the prices. So these now, base metals and grains have been weak. And as of today, the base metal index just barely making new lows from taking out the lows at Christmas time. So, and then occasionally we look at some of the commodities that most folks really don't trade. Iron ore price keeps going down. We took a look at thermal coal price, and I remember that was 44 last week. This week was 42. New lows for the move. And within the commodity rally we expected, crude oil made a nice one and became overbought. So unfortunately, Mother Nature is dealing a bad hand to the commodity people, and there's actually one major, well-known, globally known commodity guru, and he's so run out of stories trying to explain a bull market and things that on the agricultural prices for the last while he's been explaining that what will make it bullish for agricultural prices is that the average age of the farmers getting older and they're going to retire. So agricultural prices go up because there's less farmers. I mean, I've never heard anything so silly in all my life.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. Bob, how are gold and silver doing?
Well, quiet. Again, the recipe that the hard asset guys have been following, that the Federal Reserve is irresponsible, the dollar will go down, and hard assets will go up, has not been working. On the longer picture on this one, and there was a big, which we took to be a cyclical high in 2011 for commodity prices, and they've been coming down ever since. And that also signal was on precious metals as well, not just base metals. So they've been coming down since. So in November, we put out a special study and looking for a bottom in the precious metal sector. That would require that gold shares would start to outperform the bullion price, which did start, and that silver would begin to outperform gold, which did start. So the first rally out, boom, it really moved. And then it corrected, and either you were looking at gold or silver ratios and stuff, it went down and made a slightly lower low. So then the next rally up in the February, I guess it was, it didn't make it, and we advised taking some money off the table. And then there was another sell-off, and then I guess the last rally up into May, again, it was to take some money off the table. So for this year, it was to buy a little back in November, December, and then sell a little. So we're neutral. It's going to take a while before the price of gold and silver get themselves sorted out. And then also, we've been pointing out that really, if you're positioning gold to make money on from the currency change, that's what you're doing. You're betting against currency changes. The old gold bug story about evil Federal Reserve and price of gold going up forever, that was all in the market back in 2011. So we're going to go back to our investment roots here and say at some point the gold stocks will be the place where investors will want to be. It'll be due to improving earnings from the sector, which in a post-bubble deflation is dependent on their costs of mining falling relative to the price, their costs of mine falling relative to the bullion price, and that is probable at some time. But as I say, we're neutral. If the fall turns into be a lot of forced liquidation of various asset prices, the gold shares will not be able to survive that either. So that's why we're neutral. And as I was talking to my colleague here this morning, we're looking around to see if we can find something we could be positive about. And no, can't find it. Other than there could be some long trades on the U.S. senior exchanges through the summer, but this is just going to be a trading market. So anyways, and we're also hoping for a very nice summer as far as weather goes, no matter where people are.
Well, we have a great forecast for Father's Day.
Yeah, what are you up to?
I'll be watching Team Canada play Switzerland.
Well, on Father's Day in North Vancouver, there's always a car show, Italian and French cars on display, so I'll be going over in the old Alfa Romeo, and the weather forecast is reasonably good, so it should be a good outing.
Have fun.
You too then, Jim, and thanks a lot.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.